Hello, everyone. This is Nick Ryder, the Chief Investment Officer here at Kathmere Capital Management, and this is the 2022 Market and Economic Recap webinar. We'll jump off right at the top here with just a high-level summary of global market performance comparing 2022 to 2021 on the right-hand side of the slide. You'll see the performance of a variety of asset classes in 2021. Really, what you can see then was a pretty good year for particularly U.S. stocks. Had double-digit and plus gains. Non-U.S. stocks holding up quite well, and bonds were kind of meh in 2021. 2022 certainly a reversal of that story, where it was really a year where not a whole lot worked for investors, save commodities. They're up double digits. Um, Broad-based asset investors pretty much seeing losses across the board on their portfolio there, with bonds down roughly double digits, U.S. stocks and non-U.S. stocks both down nearly into the 20%. And you can see all the way to the bottom of the left-hand side of the slide, interest rate sensitive long-term treasuries as well as technology stocks down nearly 30% there for the year. In the ensuing slides, what we'll do is touch base on a variety of the key themes, both in the economy and markets, and dig a little bit deeper into the performance within both the bond and the stock markets. Jumping from an economic perspective, what we see here is we're plotting quarterly real GDP growth. What you saw was on the right-hand side of the slide, two negative quarters to start the year for GDP growth, with a negative 1.6 and negative 0.6 in the first and second quarters before growth rebounded a bit in the third quarter, up there 3.2% on an annualized basis. Right now, as it looks, fourth quarter's looking to be positive again, with the consensus expectation be for growth of about 1%. All in, that would put GDP growth into slightly positive territory for the full year. One area where things have been unequivocally strong has been the labor markets. Unemployment rate ended the year at 3.5%, right at a half-century low, matching the level we saw there right into the pre-COVID environment in late 2019 and into the first few months of 2021. You'd have to go all the way back to 1969 to see a reading lower, where we saw 3.4%, which was the all-time low in the unemployment rate. All told, employers added 4.5 million jobs in 2022, marking the second strongest year of job growth on record. 2021 coming in. All in, the economy's about 2 million jobs stronger than where it was heading into COVID, as all the jobs lost during COVID and some have been regained. Another demonstration of strength in labor markets has been just looking at the amount of job openings relative to the amount of unemployed people. 5.7 million unemployed persons in the economy at the end of the year. Being outstripped nearly by a factor of 2 to 1 in terms of job openings. There was 10.5 million job openings at the latest figure in November. And what you've seen there is just that employers is clamoring for workers, and it actually puts labor in a pretty strong bargaining position, which is where you've seen continued wage growth and income growth. Looking here at the next slide, we can see that personal income on a year-over-year basis up 4.7% as of November, which is the latest available figures. And you can see that's pretty strong, or at least in line with historical average there, maybe a touch above. You see obviously a lot of noise in the COVID era when you look on a year-over-year basis. A number of those spikes resulting from stimulus payments and and then even the negative just being the offset of that when you look on a year-over-year basis. But all in, what you've seen is kind of labor markets very strong, employers adding jobs, the unemployment rate remains low. The unemployed number being far outstripped by job openings, that's led to some wage growth. So a lot of strength happening in terms of the consumer and the overall labor markets when we look at the economy from a macro perspective. Of course, the big story from a markets perspective in 2022 was inflation. We can see there just rolling annualized inflation here dating back to the 1960s. What we saw was inflation spiking to a 40-year high there. Peaked out at 9.1% on a year-over-year basis in June. We've seen some moderation in the back half of the year. The December reading, which was just published earlier this week, showed 6.5% year-over-year inflation. If you strip out volatile energy and food components, in core inflation, as it's called, 5.7%. And the trend is certainly positive here as we look over the last couple of months to end the year. Inflation coming down much more in line with policymakers' targets of about 2%. Depending on the exact metric you look at, you're either slightly above or slightly below that. if you isolate in the fourth quarter from an annualized perspective. So certainly a big inflation spike. Certainly the trend is heading in the right direction. But probably inflation beast is not quite quelled yet, although obviously a lot of debate in markets about that. What we have seen, obviously, was inflation, the big part of the story last year. The Federal Reserve monetary policymakers responded aggressively to inflation in this, the last 9 months of the year. We've seen the Fed has embarked on its most aggressive rate hiking cycle, dating back here to the late 1980s. You can see after kind of being a little dismissive of inflation as transitory, beginning in March on St. Patrick's Day, the Fed embarked on a pretty aggressive rate hike cycle, raising rates from 0% back in March when they first started to ending the year at 4.25, between 4.25 and 4.5. As things stand currently, the Fed says they anticipate hiking another 75 basis points to 100 to a full percent next year. I take that all with a grain of salt. When we came into 2020, Fed officials were expecting they'd only raise rates 1%. So their ability to forecast is just as challenging as many others. Nevertheless, what you have seen from a historical perspective, a very aggressive hiking cycle to date. The result of this has been, of course, that interest rates across the what's called the yield curve rose pretty materially in 2022. You can see the gray line represents yields across treasury bonds of various maturities in 2021 to end the year, where they ended the year there on the green line in 2022. And you see rates across the board significantly higher, with the 10-year treasury rate being the focal point, raising from 1.52% to begin the year to 3.88% to end the year. The result of this has been, of course, that it was a very rough year, historically rough year for bonds. Bond prices move inversely to interest rates. Higher rates equal lower prices and poorer returns in the here and now. What you see all the way on the left-hand side of the slide here is the broad taxable bond market down 13% for the year. Municipal bonds faring touch better, down 8.5%. Really, the name of the game was interest rate sensitivity there in the middle section. By maturity is just a measure of interest rate sensitivity. Short-term bonds, which are far less sensitive to rate changes, down only 3.8%. Long-term treasuries, which are the most sensitive to rate changes, down nearly 30% for the year. The right-hand side just shows differentiation of returns by credit quality or risk of default. So you see treasuries there down 12.5%. Riskier or more credit riskier investment grade bonds down 15, high yield bonds down 11. A lot of the difference there is actually just difference in composition of those indexes in terms of rate sensitivity. Really, the story wasn't so much last year about the performance of different credit quality type bonds. It really was very much a rate story, and the story was one of negative returns across the board. This slide here just shows how historically bad the broad investment grade bond market returns were last year. You see, as I said, down 13%. With the bars, the dots along the way plot intra-year drawdowns. What we saw was actually at a point earlier in the year in September, rates were down, our bond market was down nearly 17%. You see both of those numbers really as outliers going back in the full history of the Bloomberg U.S. Aggregate Index, which measures the taxable bond market. By far the worst year we've seen on record, dating back to the 1970s. The silver lining of all this, of course, is that with rates higher and returns negative last year, that our expectations of returns going forward across bond markets are much higher. Just here plotting a chart, this comes from an asset manager DoubleLine, plotting returns or the yields on various both traditional and non-traditional segments of the bond market, where the yields were entering 2022 at, i.e. the end of 2021, and where they ended 2022 in the darker bars. And you can see across the board, yields are materially higher. That just puts bond investors in a much stronger place going forward, as we have a much higher yield cushion to start the year, and that's really our return expectation then going forward. So silver lining to offset some of the losses from last year is that our return expectations are now higher. And you particularly look at some of the non-traditional segments, very healthily positive yields in some of those segments. If you think about like high yield corporate bonds, for instance, sporting a yield of nearly 9% there at the end of the year. Even on the significantly safer side of the bond market, or less volatile side, if we think about kind of what we'll call cash and cash substitutes, the yield landscape is materially higher, and we're seeing yields that we haven't seen really since preceding the global financial crisis. You have to go back to the the mid aughts really to get yields like this on. You see taxable money market funds from both government issues as well as private money markets yields in the mid fours and low 4% there. When we look at some ETFs that hug, ultra short and short term bonds, we think of these as kind of cash substitutes in exchange for a little added volatility. You get some higher yield, well into the mid fives in the case of two prominent ETFs there. And then even on the municipal side, we see municipal money market funds yielding about 3.2% now, a short duration municipal ETF with 3.3. When you think about those on a taxable equivalent basis, i.e., the fact that the income from municipals is tax advantaged, when you think about that on a tax equivalent basis, those yields are actually into the 5.5% or so range, or low 5% in the case of the money market, and about 5.25% there on the ETF. So even for investors prioritizing safety within kind of their fixed income allocations, opportunities to earn some healthy yields now as a result of today's higher rates. Flipping now to the stock market, just plotting the returns for 2021 for a variety of headline indexes there over on the left-hand side. I mentioned earlier the S&P 500 down 18% for the year. The Dow Jones Industrial Average down 6.9%, and then the tech-heavy NASDAQ index very much lagging last year, down 32.4%. As we move our way to the right on the slide, you see large cap stocks and small cap stocks more or less in line with one another, where you did see some deviation. Then as you move further to the right, value stocks handily outperforming their growth counterparts last year. This has been what we think is perhaps the beginning of a reversal of a longer term trend where the last decade growth had really led markets. We've been advocating for a tilt towards value for some time now. Good to see some value outperformance. We hope that this is just the beginning in terms of a sustained run of value outperformance potentially. And then furthest to the right, looking at non-US stock markets, surprising perhaps to many to see that developed markets actually outperforming US markets by a 4% or so margin there. Emerging markets trailing a touch. All in a non-US stock market index actually outperformed the US. If we think about the S&P 500 last year, probably a surprise to many given the very real and negative headlines emanating from both Western Europe as well as Asia Pacific region. When we look at the market last year, what we saw was the market repriced pretty materially. So here we're plotting the price to earnings ratio on the S&P 500 index. You can see over on the right-hand side, we saw the market become, decently more attractive from a valuation perspective as the year went on. We entered the year pretty expensively valued from relative to the last 25 years. PE ratio was a touch north of 21 times earnings coming into the year. We ended the year at 16.5 roughly. That's about a 22% cheapening of the market. Really explains all of the decline for the S&P 500 last year. And what you see is that market ending the year with roughly what I'll call average valuations across a variety of metrics relative to the last quarter of century. We'll take a quick flashback here. I'm going to touch on two additional themes to wrap things up today, but we'll quickly cover two quick slides that we'd been including in our investment review materials late into last year and into early this year. One of the things we had been warning investors about, or we were watching closely, was that the S&P 500 had become increasingly concentrated, with the top 10 stocks coming to comprise more than 30% of the index to end last year. Our concern was that those 10 stocks collectively carried rather expensive valuations. Those top 10 stocks were trading at 33 times earnings versus the market, as I mentioned before, at 21 times earning, and the remaining 490 stocks trading at 19, roughly 20 times earnings. We just saw the market as concentrated as it was in those top 10 stocks, and we're cautioning investors to make sure that they were aware of the concentration and ideally would lighten up their exposure to those top 10 names. And we'll touch on kind of how that has played out. The other theme we had talked about really was very much related to the concentration was, the sustained run of both technology and growth outperformance versus the broader market. Investors coming into early 2022 could be forgiven for, looking at trailing 5, 10, 15-year returns and saying, why wouldn't I just be exclusively in large cap stocks or technology stocks, given how well they had performed relative to, value stocks, small cap stocks, and non-US stocks? Our advice at the time was, related to the valuation, which we just covered on the previous slide, but also we had seen this story play out before. Looking in early 2000, investor would have seen the same thing had they looked in the rearview mirror. And then we knew how the early parts of the 2000s played out, where the overall market environment wasn't great, but tech and large cap growth really bore the brunt of things, and value in non-US held up materially better than those other parts. When we look at 2022 returns, somewhat presciently, we did see those largest 10 stocks dramatically underperform the overall market. So looking at on the left-hand side, those top 10 stocks in the market as of 2021, how they fared in 2022, we see Apple and Microsoft both down 25 to 30%, Amazon, Tesla, Nvidia, Facebook's parent Meta down more than half each, and then Google's parent Alphabet down nearly 40%. You did see Berkshire Hathaway, JP Morgan, and Johnson & Johnson hold up materially better than those stocks. And then you can see all the way on the right-hand side how that fared relative to the index down 18, the average stock in the overall index down 12, and value stocks down 8. So very much kind of playing out to some extent how we expected, which was we were worried about the risk of some overvaluation in those stocks, and it seemed to play out that way last year. Related to the same theme of growth and tech outperformance and what we saw as some of the speculative activities happening in the market, looking here at just a variety of individual stocks that I think, encapsulated the viewpoint of many, or the attention of many in 2020, 2021, where it was very much a number of these tech and consumer-driven stocks were very much in vogue, had run up to very expensive and what we thought were speculative levels. We were warning about this. Many of these companies shown on the slide here were not profitable enterprises, were actually losing considerable sums of money. We were just worried about what we thought was some significant speculative activity happening in the market, and that at least cautioned people to not get too carried away, given what we saw was pretty significant downside risk to a number of these stocks. That did play out in 2022 as some of the air was let out of what we thought was the tech and consumer bubble. And you see just a snapshot or sampling of these stocks, many of which down well north of 50% for the year, badly trailing the market and giving back nearly all of their gains relative to the overall market, if not more. Emblematic of this kind of same theme or trend was here we just plot the 3-year performance of the 3 popular ETFs, the S&P 500 Index Spider, the NASDAQ Index Tracking QQQ ETF, and then a very popular ARK Innovation themed ETF that investors broadly just seem to not be able to get enough of, particularly during 2020. And what we've seen is kind of a round trip, full cycle performance of the innovation and tech ETFs. You can see the ARK there in its purple line, significantly outperforming in 2020. You saw tech stocks in the blue line outperforming really in 2020 and into 2022, and then the steady old S&P 500 index. What we've seen is just a significant sell-off, particularly in the ARK ETF, down nearly 80% from its high. The NASDAQ down roughly 35% from its high to end the year versus the S&P, which was down about 20 and change from its high. So something that we had been watching closely, had been cautioning against, and it has played out that way, where some of the speculative fare has come out of the market. Last thing I'll touch on here is just global equity valuations. We continue to remain proponents of global diversification, really from the story of valuations, that we just look at U.S. stocks still, while now average relative to a longer term here, we're showing a 15-year average. Previous slide showed a 25-year average. More or less average valuations in the S&P 500 index. What we see, though, is non-U.S. developed market stocks represented there by the EFA index, trading at about a nearly 30% discount to the U.S. markets. Emerging market stocks, even a more 32% discount to the U.S. markets. Both of those trading cheap relative to their own history, and particularly cheap relative to the U.S. market. And you see that while on average they've been cheap, it's not always the case. Coming into late 2009, 2010, you did see kind of all these valuations in line with one another. What you've seen is this gap widen out. We look today and just see attractive valuations outside of U.S. markets. We do think that they do set the stage for some potential outperformance in the year ahead from non-U.S. markets. At a minimum, we continue to just advocate for being diversified, as We don't know where returns will come from around the future, but we do know that non-U.S. stocks account for roughly 50% of the stock market capitalization around the globe and continue to advocate for remaining diversified there. Lastly, just wrap things up. I won't touch on all these. These slides will be available to all webcast listeners. Just a few of the things we're watching in 2023 and beyond. From a macro perspective, it's really going to be about inflation and whether or not we move into a recession and what will be the impact of that. From a corporate fundamentals perspective, really looking at how would companies fare in a recessionary environment, and also how are companies at large dealing with inflationary pressures and increased costs. And then from a markets perspective, really just looking at what's going to happen with overall risk appetites, i.e., and then how they impact valuations. And then the two things kind of following what we talked about: will value continue its resurgence versus growth? And will international diversification continue to, quote unquote, work for investors going forward, as we believe they will? So that was fast paced. That's all I've got for today. As always, if you have any questions, please don't hesitate to reach out. And thanks so much for listening in today. And we wish you a happy, healthy, and prosperous 2023.